The hardest part of trading isn't reading the chart. It's accepting that a perfect setup still has a 40% chance of failing and taking the trade anyway. Most traders believe their biggest enemy is the market, high-frequency algorithms, or market makers hunting their stops. In reality, the most destructive force in your trading career is your own biological response to uncertainty. We are evolutionarily wired to seek safety and avoid pain, but successful trading requires doing the exact opposite. You must constantly embrace risk and step into uncomfortable situations when the math is in your favor. The foundation of Al Brooks' psychology is not positive thinking, it is probability management. When you understand the mathematical expectancy of a trade, fear disappears because you are no longer gambling. You are executing a business plan. Let's begin with the concept of the trader's equation. Every decision you make on a chart involves three variables: probability of success, risk, and reward. Psychology fails when you ignore one of these. If you take high probability trades, the reward is often smaller compared to the risk. If you take low probability trades, the reward must be huge. Most beginners want high probability and huge reward, which rarely exists. This desire for the perfect trade leads to hesitation. You wait for too much confirmation, and by the time you feel safe to enter, the move is already over. This is how the market punishes the need for certainty. Consider the wall of worry. In a strong trend, pullbacks are shallow and look weak. It feels scary to buy because the market looks overextended, but buying high in a strong trend is actually the high probability play. Conversely, in a trading range, the market looks safe at the breakout point, but that is exactly where the probability of failure is highest. Your brain says breakout, but the market math says trap. This creates the cycle of fear and greed. You get greedy at the top of a range because green bars look good, and you get fearful at the bottom of a trend because red bars look scary. You must learn to read the context, not just the color of the last bar. Let's discuss the 40 to 60 rule. In a strong trend, the probability of continuation is 60%. In a trading range, the probability of any breakout succeeding is only 40% to 50%. When you are in a trading range, you must assume every breakout will fail until proven otherwise. This requires the discipline to sell when the market looks strongest at the top and buy when it looks weakest at the bottom. Many traders suffer from recency bias. If they lost their last 3 trades, they are afraid to take the 4th, even if it is a perfect setup. This breaks your statistical edge. Look at this sequence. A trader with a 40% win rate can still be profitable if their winners are large. If you skip trade 4 because of fear from trades 1 to 3, you turn a winning system into a losing one. How do we build the mental toughness to take that 4th trade? We rely on signal bars. We do not guess. We wait for the market to print a specific bar that tells us the probability has shifted. A good signal bar is a reversal bar with a strong close. It is the market's way of signing a contract with you. Without a signal bar, you are guessing. With one, you are trading. However, even with a good signal bar, you must accept the risk. This brings us to revenge trading. This happens when a trader personalizes a loss, feeling the market took their money. Revenge trading usually occurs in barbed wire conditions, tight trading ranges with overlapping bars. You enter, get stopped out, re-enter immediately, and get stopped again. You are fighting a market that has no direction. The antidote to revenge trading is the 2-loss rule. If you lose 2 trades in a row in the same time frame, stop. The market context is likely different than you think, or you are emotionally compromised. Another psychological trap is FOMO, fear of missing out. This usually happens during a buy climax. The market goes vertical, and you feel like you must buy or you'll miss the move of the century. Professional traders are selling into that vertical spike. They know that a vertical move is unsustainable and is usually the end of the trend, not the beginning. Buying a climax is the highest risk trade you can make. So, how do we structure our mind for success? We must think in sets of 20 trades. Do not judge your success on today's P&L. Judge it on whether you followed your rules over the last 20 setups. This removes the pressure from the current trade. If you know you have 19 more trades to play out the probabilities, a single loss becomes statistically insignificant data, not an emotional failure. Patience is another critical skill. Al Brooks often says, "I am paid to wait." You are not paid for the time you spend in a trade. You are paid for the quality of the decision to enter. If a setup is not clear, the probability is usually 50%. If you trade 50% setups with a 1:1 risk-reward, you will lose money due to commissions and slippage. You must wait for the 60% setup. Let's review a practical example of mental discipline on a chart. Here, the market sells off strongly. It is tempting to sell the low, fearing the market will crash without you. But a disciplined trader looks left. They see we are at the bottom of a 4-hour trading range. Instead of selling the momentum, they wait for a buy signal, or they simply sit on their hands. To improve your psychology, you must lower your position size. If your heart races when you enter a trade, your size is too big. You cannot make rational mathematical decisions when your nervous system is in fight or flight mode. Gradually increase size only when your trading is boring. Good trading should be boring. It is the repetitive execution of a statistical edge. If you are looking for excitement, go to a casino. Remember the concept of always in. At any moment, you should be able to say whether you would be long or short. If you can't decide, the market is likely in a trading range, and you should be flat. Handling profits is just as hard as handling losses. When a trade goes your way, the fear of losing the profit kicks in, and you exit too early. This cuts your winners short and ruins your trader's equation. To fix this, use technical exit rules, not emotional ones. Exit when the market breaks a trend line or prints a reversal signal, not when you feel like you've made enough money. Let's summarize the mental framework. First, accept that uncertainty is permanent. You are trading probabilities, not certainties. Second, risk is the price of admission. Third, patience is your edge. Wait for the setup that matches your plan. And fourth, never trade large enough to trigger your emotional threshold. Your goal is to become a machine that executes a strategy. You observe the price action, you categorize the market type, you find the setup, and you execute without hesitation. In our next video, we will combine this psychological resilience with advanced support and resistance techniques to pinpoint entries with even greater precision. Mastering your mind is the final step in mastering the charts. The market will always be chaotic, but your response to it can be disciplined, logical, and profitable. Trade the chart, not your emotions. See you in the next video.